Hello and welcome to Business Morning. I am Bisi Adebayo. Let's kick off with new data showing Nigeria's total public debt has risen further to a new high of 31 trillion naira or $85.897 billion as at June the 30th. According to the Debt Management Office, the amount includes the debt stock of the federal government, the 36 states and the Federal Capital Territory. The latest increase is 2.381 trillion naira or 8.3% higher than 28.628 trillion naira, which it stood as at March the 31st this year. And the DMO attributes the increase in the debt stock to $3.36 billion budget support loan from the International Monetary Fund, as well as the issuance of sukuk and promissory notes. Meanwhile, the debt office says that the figure could rise further due to additional promissory notes expected to be issued in the course of the year and new borrowings by state governments. Now, let's tell you about the survey of the financial derivatives company suggesting that a likely increase in the headline inflation to 12.95% should be expected from the National Bureau of Statistics, and the projection for August headline inflation, which represents a 0.13% creep up in price level, will put the increase at 30-month peak. According to the economic think tank, the pace of increase has slowed significantly and could be approaching a point of inflection. The spike in money in circulation, coupled with the 6.1% contraction in GDP, are some of the factors that contribute to the rise in inflation. And for oil prices, they are lower today, but still trading around $40 per barrel after data showed U.S. crude stockpiles unexpectedly rose last week, stoking concern about a sluggish recovery in fuel demand as coronavirus cases continue to surge in many countries. U.S. WTI crude futures were down 0.63% at $37.81 a barrel, while Brent crude futures dropped 0.42% at $40.62 a barrel after rising 2.5% on Wednesday. The oil market has been under pressure lately on the prospect of both subdued demand and rising supply. And the U.S. Energy Information Administration will also release official weekly inventory data later today, and that's coming a day later than normal following this week's U.S. Labor Day holiday. And bringing things back home now, the full deregulation of the petroleum downstream has taken effect after the Petroleum Products Pricing Regulatory Agency, PPPRA, confirmed the development earlier in the week. And based on economic principles, this is expected to contribute to inflation rate, which is even projected to rise to 12.95%. However, we're yet to see the effect on transportation fares across major parts of the country. Well, joining us now to analyze the implications and economics of the deregulation is Channels TV data analyst Babajide Ogusonwo, who is right here in the studio. Good morning, Babajide. Thank you for coming on the program. So tell us, what was the biggest factor that influenced the federal government's decision to deregulate petrol prices?
I'd like to take that question maybe from a slightly different perspective, which is how much do you spend to fill your tank now? Maybe I should ask you that question.
No, you answer the question yourself.
I think because your husband buys the petrol.
I buy it myself, but answer the question.
But perhaps we'll look at that question, but we should also, I'll share some facts with you on how many Nigerian men and women own vehicles in Nigeria, and I think the answer will surprise you. But before I share that with you, I'd like to talk about what you had asked me, and that's what has been the biggest factor that has influenced this decision. Is it the rising debt, which you talked about, 31 trillion naira, Nigeria's total debt, or is it something else? Is it the falling revenue? But the evidence we have shows that the key word that has caused the change and the options that are available to the government right now is one thing, and that is reality. There's a new reality. And now, what is this reality? I'd like us to take a look at what has happened since this government came in the second quarter of 2015 and look at how our crude oil exports have moved. And that picture will allow us to understand what is going on. And from that evidence we have, in the second quarter of 2015, when the government came in that quarter, we sold oil worth $10.1 billion. That seemed to be a lot. But even things got better. By the third quarter of 2018, Nigeria was selling $13.5 billion worth of oil as at the third quarter of 2018. The government has been in power for 21 quarters. The evidence from the National Bureau of Statistics about our crude oil exports in the second quarter of this year was that we sold only $4.4 billion worth of oil. Only $4.4 billion worth of oil in the second quarter of this year.
So what's responsible for the drop?
Now, that's been because of COVID. We've seen lower oil prices and we've seen lower oil volumes. In summary, the second quarter of 2020, where the country sold only $4.4 billion worth of oil, has been the lowest crude oil revenue since the government came in. And so what has happened is between 2015 to 2020, the government is now being faced with reality. And the reality is there is no more revenue to be able to spend on subsidies that aren't producing, that are not productive anymore. But here's why crude oil remains and the crude oil revenue is important. Crude oil, based on the evidence we have from the NBS, shows that crude oil still accounts for 71% of everything that we sold as at the second quarter of this year. We are waiting for the third quarter data, but based on what has happened, we are not going to likely see any significant difference between the crude oil volume sales and the crude oil value sales in the second quarter of this year and third quarter. So the key word about what has happened and why we're going for an open market for pricing of petroleum is because of reality. The reality is that crude oil, the amount of money we are making from our crude oil exports is now at an all-time low.
And we've been talking about diversification over the years, and we're still at this point now.
No, diversification, we haven't been able to really, and that's one of the things, the challenges that we still face. Diversification into agric. The evidence shows that even though we sold 6 trillion naira worth of, when we're looking at the narrative, 6 trillion naira worth of goods in the second quarter of this year, only 2%, BC, only 2% was based on processed food and beverages. And so we're still exporting significantly. We're exporting crude oil, which is our major source of revenue. The second thing is that crude oil revenue has dipped and non-oil revenue is still yet to grow. So we still need to put in a lot of investments into our non-oil sector.
But having said that now, is there any research to confirm that high-income earners actually benefit the most from petrol price subsidy?
Now, high-income earners, I don't know if I should classify you as an high-income earner, but here's the evidence we have. Today in Nigeria, we have 100 million adults. Now, you can probably hold that figure in one hand. 100 million adults. But the evidence from the Federal Road Safety Commission and the National Bureau of Statistics shows that even though we've got 100 million adults, there are only 5 million vehicles in Nigeria. 5 million private vehicles to be specific. In other words, 95% of adult Nigerians do not own vehicles. And so there seems to be some evidence that it's the few private vehicle owners, the less than 5% of adult Nigerians that are really getting the benefits of regulated price. They are getting the benefits of a subsidy. Now, does this mean that those that do not own private vehicles do not get any benefits? Yes, they do get benefits, but those that get the direct benefits by driving their private vehicles to the filling station, the evidence shows that only less than 5% of Nigerians, adult Nigerians, have their private vehicles. And so while the deregulation will affect everybody, perhaps those that have their private vehicles, those that go around with commercial transportation will also see rising prices. But perhaps I will also want to now take a look at the change in inflation, because that is the key challenge Nigerians are facing. Not really about the price, it's about the implications of the price adjustments. And the implications of the price adjustment, if we look at the inflation results over the last 21 quarters, month on month, we'll see that inflation yesterday in Nigeria is at 12%. But looking back at what had happened in 2017 when inflation rose to as high as 18%. So the government needs to focus on making sure that we reduce the rising cost of goods, look at how to minimize the effect on Nigerians. A lot of Nigerians spend most of their income on food. And so it lets us understand that even though we're removing the subsidy, on petrol, there are three other subsidies that are important for the government and important for Nigerians, and those subsidies need to be consistently talked about. The first of these three subsidies is we're having a subsidy on the exchange rate. By the subsidy on the exchange rate, we need to take a decision, a very firm decision on, do we want to have variable multiple exchange rates, whereby some people get the dollars at a lower price and are able to, because of maladministration, are able to earn some profit on it. So the government needs to also understand that there's a subsidy on the exchange rate. The second subsidy is there's a need to have subsidy on production. Now, by subsidy on production, the government needs to be able to provide some farmers and provide, in fact, a lot of farmers subsidize agricultural imports. So yes, we're taking out subsidy on petroleum products, but the first is we need to review our subsidy on the exchange rate. We need to look at the subsidy on production. And the third and final subsidy is we need to look at how and what our decision will be when it comes to subsidizing credits. And that is, credit has been a major challenge for a lot of Nigerians. A lot of businesses, I don't know if you've ever been able to get, apart from what sometimes we're able to get, the salary advance, but there are millions of Nigerians that don't still have access to credit. So the government needs to focus on three things, as I mentioned: subsidizing, looking at the subsidy that is going on in our exchange rate, looking at effectively implementing subsidies on production, and looking at our subsidy on credit, which is making credit more affordable and available for millions of Nigerians. If we're able to manage these three subsidies, it will really reduce the effect of the removal of the subsidy on petroleum.
Well, now let's still talk about the implications of all of these. Now, you talked about the use of vehicles, but it's not only vehicles that use petrol. Generators are there as well. And a lot of businesses actually depend on their generators to run their businesses. So what ripple effect, will this have?
So it depends. First of all, a lot of Nigerians spend money on fuel, generator, but the evidence we have today shows that majority of Nigeria's spending, 56% of Nigeria's spending, goes on food. The evidence from the National Bureau of Statistics gives us information about what percentage of your income, of your expenditure, goes on fuel and on light. And from that evidence, they say that about 6% of Nigerians' expenditure goes on these items. But perhaps let's take a look at another perspective, which is we've seen the changes in crude oil price. We've looked at inflation. To look at those that are arguing that what are the benefits or what are the challenges the real challenges of we taking out the subsidy. And if we really focus on it, we'll realize that whenever a subsidy goes, there are benefits and there are challenges. And a poll that was conducted recently, and we asked Nigerians that should the subsidy stay or should the subsidy go? Because at the end of the day, it is Nigerians who are feeling the effect of it. The poll showed that majority of Nigerians, 53% of Nigerian samples, said that the subsidy should go. 41% said the subsidy should stay. And about 6% said they didn't know. So even looking at what Nigerians really want, Nigerians want the subsidy to go based on a nationally representative poll that was conducted. And that is the fact. The second is, even though most Nigerians want the subsidy to go, it is to look at what are the effects of removing the subsidy, what are the merits and the demerits of the subsidy. And if we take a close look at that, there are three things that I'll classify as the beautiful things, the beauty of subsidy, and there are the three beasts of subsidy. The first beauty of subsidy is that if you look at it, what happens is whenever the subsidy, now that the subsidy has gone, it means that there's going to be more revenue to the government to invest in sectors such as health, such as agric, such as security. Another benefit is we're going to see less revenue losses to the government due to maladministration that often happens whenever the government is involved in business. So we're going to see less revenue losses. We're going to see more opportunities to be able to invest in critical sectors, because now the government can use that money if they choose to proactively invest in other things. And as well, we're going to see, because it's now open, we're going to see more private sector competition. And whenever we see competition, one key thing happens, and it's called innovation. So the expectations, no guarantee, BC, but the expectation is that private sector participants will improve, will become more competitive, and then we'll see some innovation across the downstream sectors, especially across the filling stations, service standards, and the all. But even though we've talked about the benefits, some benefits, these three benefits to Nigerians, let's not hide the fact that there are some challenges that Nigerians will face based on this. And the first challenge is families, you and I, we're going to have to be thinking critically about how we spend money. And so some items that we would have bought without thinking twice, there's going to be a lot of second thinking before we buy some of those items. So some producers will see that demand for their products will increase, and that's because Nigerians are buying less of those items because they still need to go out and transportation is important. The second is we're going to see people depleting their savings because income isn't increasing and inflation is rising. And so we're going to see families taking out of their savings, individuals taking out of their savings as well to be able to meet their general daily needs. So there are challenges and the opportunities that the petrol price deregulation offers. But at the end of it all, let's not forget that it is all about the new reality. And the new reality is we need to be more effective and efficient as a nation with the decisions we make, especially on how we spend and allocate our money.
Now, let's talk about the petrol imports, of course, which the PPPRA or NNPC has approved for private marketers to engage in. Now, how possible can that be now that the full deregulation is here?
I think it's a good possibility. It's a good possibility. We've seen the PPRA talk about petrol price bans. The effect at the end of it all is we're trying to get to a position where, like every other household item Nigerians have been used to paying for, petrol becomes among those sort of commodities. So today, you buy tomatoes from the market at the price at which the market woman chooses to sell, but you could choose to buy your tomatoes at a higher price from a supermarket. You could choose to buy, there are different types of breads, there are different types of commodities. So what I see and what could likely happen is we'll be seeing different petrol grades. So we'll be seeing unleaded, we'll be seeing premium petrols, we'll see a lot of volatility in petrol prices, we'll see a lot of improvements in service standards, we'll see some sort of loyalty schemes, because now the space is open for people to think. What had happened before was because of the subsidy, a lot of investors were not thinking, and they were just playing on arbitrage opportunities, and they were milking the nation. Again, let's not forget there are benefits of the deregulation, and there are also challenges. What the government now needs to do is to understand the challenges and create policies to mitigate challenges that more than 100 million adults, Nigerians, and their families will face.
Now, what about the large private refineries now? When will they kick off, and, what impact would it have on all of this?
Well, the challenge with large refineries is the large refineries private sector, but the question is how much will crude oil sell for in another 5 years? We are seeing electric vehicles coming in. So the large refineries also have to understand that this oil business, crude oil, refined crude oil, is perhaps a business that is declining. So the large refineries need to understand that whatever they are doing, it is likely going to be an investment to the short and medium term. Based on all global indicators, crude oil and crude oil proceeds are short to medium term investments. In the longer term, we'll be seeing less petrol-driven cars. We'll be seeing more electric-driven cars. And that trend will start from United States, from Europe, from Asia. And the advantage the large refineries will have in Nigeria is it might take some time, perhaps 2 decades, before Nigerians really start getting into the groove of electric vehicles. So the large refineries might still be able to survive again in the short to medium term. But it's very unlikely that in the next 3 or 4 decades, it's very unlikely that your children and my children will drive petrol cars. Most likely, our children and grandchildren wouldn't really know petrol cars. They will know electric cars. And perhaps if Nigeria is able to think of how we also can start getting involved in motor assemblies, assembly lines for these electric vehicles, and we see a lot of private investors trying to look at partnerships to be able to catch in when that trend comes in.
All right, Babajide, that would be a very good point to leave the conversation. Channels TV data analyst.
In the final analysis, it is always better to
go
debate
now.
a
We
question.
have to take a break now.
The pleasure is all mine.
All right, Babajide Ogusowo, thanks for coming on the program. Our commodities market update will be up next in just a moment. Please stay with us. Welcome back. Now let's discuss today's burning economic issues at the domestic commodities market with a research analyst at the financial derivatives company, Temitokpe Olugbele. Good morning, Temitokpe. Thanks for coming on. Well, let's begin with oil prices now. They're trading around $40 per barrel. Of course, the market has been very, very volatile lately. But what are the factors that are driving the markets at the moment?
Okay, so like you mentioned, yesterday the market was extremely volatile, trading above 40, below 40 intraday. And, we saw that, we're about $40 per barrel now. I think what's going on with the oil market now is just a flood of bearish sentiment, right? From the rising coronavirus cases in, India, the UK, the US, to, EIA coming out to further reduce its oil demand growth forecast for 2020 by over 200,000 barrels. So these bearish sentiments, we see that, these bearish sentiments are really pushing down prices, and that's what's happening with oil. And, what we're expecting now going forward is there's going to be like a market monitoring panel meeting next week of the OPEC Plus team. So they're going to meet next week, and we expect, for them to really take time to give us a strong direction as to, both demand and supply, especially supply, outlook going forward. So that's what we're expecting next week.
And where are we likely to see the prices?
Before then, I think it will still remain volatile. I think because, except we have a new bullish sentiment that raises up prices, which I don't see coming right now. So the market will still be reacting to the bearish sentiment flooding the markets. And I think it will still be $39, $40 per barrel for the week before the meeting. Then from the meeting, it will depend on the outcome of the meeting.
The markets will take a cue from
exactly.
that. All right, now let's talk about the headline inflation forecast for August, which you guys at the FDC predicts to increase to 12.95%. We shed more light on the factors that will be responsible for the increase.
Okay, so, we are projecting a 30-month high of 12.95% for the month of August for the report coming out next week. And we see that, one interesting trend that caught our attention was the money supply aspect of it, right? So we saw that using e-payments as somewhat of a proxy for money supply, we saw that there was an increase in e-payments by about 1.86% for the period. And we see that why e-payments is really catching on right now is before it had the convenience factor, it always had the convenience factor. So your e-payments include channels like your POS, right? It always had the convenience factor. But now you see that it also has the social distancing, kind of protocol factor driving that increase usage. So we see that if we take that at a time where output is contracting, we see that prices are going to, increase. That's the economic theory of it. And that's why we're projecting headline inflation to increase to 12.95%. And, we see that month on month, we're projecting a decline, actually, the first decline in, I think, 6 months, yes. And we see that we are, why that is so is because between July to August, we saw that there was the commencement of the harvest season. So that is expected to, push down month-on-month inflation. But going forward is, these policy pronouncements we got in September that is really on the, and we're already seeing that from our market survey, we're already seeing some prices increasing based on these policy pronouncements of the increase in PMS price, the increase in electricity hike. That will start to kick in and manifest from September's inflation data.
What's your latest assessment of the stock market in recent times?
Okay, so far, today is Thursday. So far this week, for the first 3 trading days, we see that the market has been negative. The sentiments have been negative. And we think that, it's first the negative investor sentiment. And it might also be profit taking from the last week's rally. We saw that there was a, literally throughout the last week, there was a rally in the stock market. So there might be that. Investors might be taking profit from that rally. And, also, investors are still a bit wary about some corporates that are yet to release their result, still wary about the policy direction, still wary about the stimulus, if it's enough to, lift corporates out of the slowdown that they saw in, during the lockdown restrictions. So we see that that's really what's happening with the stock market now.
All right, on Tuesday, the PPPRA announced the full deregulation of the petroleum downstream, and that means that marketers will now have the liberty of fixing the pump price of petrol. So what are the implications that you see at the FDC?
Okay, so, when this partial deregulation started in March, we saw that there were price bands, upper and lower limits, and, marketers were forced to, stay within that limit. So now that, they're really ripping off the bandage and saying, okay, fine, we want to go full out on this deregulation strategy, and, marketers are free to price as they will, you will see that marketers will now take in consideration, the major consideration now will be the cost of importing this PMS, and that would, take into factors like the exchange rate, that would start to play in the pricing, strategy of these marketers. But we might start to see a pricing differentiation across different retailers, but I don't expect it to be so wide, because the thing about this market is the information is free. There's an information symmetry, right? If I hear word of another, retailer selling at a cheaper price, I wouldn't come to your retail, petrol station to buy my PMS. I'd rather go to where it's cheaper, provided the place that is cheaper is close to my vicinity. So I don't expect the pricing differentiation to be so wide, because if there's information symmetry in the market. So marketers, and again, the PPPRA they've also said that they will serve as a regulation body, which they were built to be, to make sure that these marketers don't, don't go off on, over profiting and taking exploiting consumers at a time of volatile income. So we don't expect the differentiation to be so wide.
But are we likely to see prices drop?
I mean, it would depend on what's happening with the global markets, right? So, given that so far this September, we've been seeing prices volatile, we're some days, intraday, we're seeing it below $40 per barrel. That might take effect for the next PMS price review, given what the Brent prices average in September. We might, depending on what is happening in the global Brent price market. Yes.
Now, talking about Forex, now we've seen the Naira stable at the parallel markets at 445 Naira to the dollar lately.
Yeah, I mean, we've seen that there's been that stability in the parallel market. We haven't seen much, movement in terms of, the parallel markets. And as long as, the supply keeps, flooding the markets as best as it can to match demand, we see that prices right now, Naira remains stable. We hope that stability trend continues going forward. Yes.
We're all watching now. Then what would be your reaction to the suspension of the launch of the eco currency by ECOWAS? They say they want to take a gradual approach.
Yeah, I mean, the reaction basically is a safe step in the right direction, kind of, if you look at it, because given what these ECOWAS member countries are facing in terms of their domestic currencies, there's the COVID pandemic has, sent currency weakness. There's that currency weakness across different countries, not only, it's not peculiar to Nigeria alone. So it's a good time to just, take a step back, let the economic recovery path, let's start knowing what the economic, because really as we come into the post-COVID world, we'll see the economic recovery will be different across different countries, depending on your fiscal and monetary stimulus to get your economy out of the downturn. So that economic recovery path is different for countries. So when you start to see what the different member countries are, the path they are taking, then you can now kick in the ECO launch again. But for now, it's appropriate for the times that we are in to suspend that. Yes.
All right. Now, what about the external reserves? They're still climbing. Of course, they now stand at about $35.77 billion.
Yes.
So what's still fueling this increase? How much of a good news is that for us?
I mean, for the state that we are in, for the state that the delicate balance our Naira is, I mean, we can take that to be good news, but how long it's going to last remains a question that, is still up in the air. And we see that, I mean, it has maintained that trend for, I think, over a week now. And going forward, it is expected that the trend might start to change direction. I'll be honest. It might start to change direction.
To the volatility at the crude oil
exactly.
markets?
As you see that volatility continue to play out, the average price of Brent right now for September is definitely lower than what it was in August. And if this volatile trend continues, it might come in lower at the end of September than what it was in August, and that would reflect in your external reserves balance.
Now, we'll continue to talk about power, Temitope. Of course, you know power is key. So we'll always want to know if there's any new development that is worth talking about.
Right now, I don't think so, because what we saw from the latest reports was that it's above 4,000 megawatts per hour. There's really nothing new, you know. We're just waiting. We're just waiting to see that impact of the electricity hike, you know, in terms of electricity rationing, in terms of consumers starting to ration how they use their electricity. You know, since you're paying, is now cost reflective, right? You will start to see that rationing. But other than that, there's really no new development in the power sector.
So where are we in terms of commodity prices now, and what's your outlook for prices in the coming days?
Okay, so, we went on a survey this week, and we saw that, some prices are actually, flat. There was that flattening of prices. So take rice, for example, though we see that floods are washing away harvest, some of the harvest up north, we've not seen that yet to take in, yet to reflect in prices. For now, there's no how it would definitely start to reflect in prices. We also see, other commodities like beans, still, flat, and the commodities are relatively flat right now due to the, there's also the harvest season impact, the flood of commodities. We see, take yam, for example, so where we're supposed to be seeing a decline in yam prices because New Yam Festival, there's that flood of new yam, but we are not seeing that because according to the marketers, the influx of harvest this year was not as much as what you would get, after the New Yam Festival. I mean, it could be a number of factors. It could be because when the planting season was happening, there may be lockdown restrictions. Farmers couldn't plant as much as they could have in other years. So those factors are starting. We see that New Yam is not as low as it could have been and what it has been in other years. So that's really what we're saying. But going forward, we expect, the prices to really start to trend downwards as harvest season continues to play out in price movements.
Research analyst at the FDC, Temitope Olugbile, thanks for coming on the program. We'll be back in just a moment. Please stay with us. Now, let's just go over some of the headlines we brought to you earlier, and starting from oil prices, which are actually lower today, but still trading around $40 per barrel. And that comes after data showed that U.S. crude stockpiles unexpectedly rose last week, stoking concern about a sluggish recovery in fuel demand as coronavirus cases continue to surge in many countries. U.S. WTI crude futures were down 0.63% at $37.81 a barrel, and Brent crude futures were down 0.42% to $40.62 a barrel after rising 2.5% on Wednesday. The oil market now is under pressure on the prospect of both subdued demand and rising supply. Meantime, the U.S. Energy Information Administration will release official weekly inventory data later today, and that's coming a bit later than normal following this week's U.S. Labor Day holiday. And back home, Nigeria's total public debt has risen further to a new high of 31 trillion naira, or $85.897 billion as at June the 30th. According to the Debt Management Office, the amount includes the debt stock of the federal government, the 36 states, and the Federal Capital Territory. The latest increase is 2.381 trillion naira, or 8.3% higher than the 28.628 trillion naira, which it stood at as at March the 31st this year. But the DMO attributes that increase in the debt stock to $3.36 billion budget support loan from the International Monetary Fund, as well as the issuance of sukuk and promissory notes. Meanwhile, the DMO says that the figure could even rise further due to additional promissory notes expected to be issued in the course of the year and new borrowings by state governments. Time now to review Wednesday's equities market performance with Edidiong Ewang. Good morning, Eddie. The bears have continued to dominate the market. What went down yesterday?
Good morning, BC. The color of my dress is a visual representation of how the markets have been this week. And yesterday's sell-offs were due to profit-taking on banking stocks like Zenith Bank, Access Bank, and UBA. Now, that dragged the market down by 0.28% to 25,424.91 points, while the equity cap was lower at 13.26 trillion naira. Activity level, on the other hand, was higher as volume increased by about 7.3% to 269.262 million units, worth 2.85 billion naira, and all of that changed hands in 4,155 deals. The sectoral chart was negative yesterday, apart from the industrial goods counter, which was solely driven by Lafarge WACO, 0.83% on Lafarge. The banking sector, of course, took the heaviest hit by 1.54% as Zenith Bank, Access Bank, FBN Holdings, UBA, and Sterling Bank declined. Consumer goods was down 0.19%, and that was due to losses from Unilever, Vitafoam, and Honeyflower. Insurance was down 0.39%. That's as a result of losses from Royal Express and Mutual Benefit, while oil and gas declined 0.19%, and that was due to the 1.30% decline on O&O. But let's talk to Abdurrashid Momo, a stockbroker at TRW Stockbrokers. Good morning, Mr. Momo. Thank you for joining us on the program.
Good morning.
So we've seen 4 straight sessions of losses this week. Could that be the beginning of a bearish market?
Yeah, to some extent. How will I start? I heard you say Zenith. Zenith was actually the beginning of the whole issue we had on ground. Most investors were excited with the financials that was reported last week. And those were the financials a lot of investors have been waiting for. But you need to know something. There are different players in the market. We have the investors, we have the traders, we have also what we saw where Zenith was about 15 plus, or this trend started from when it was around 10 or 11 naira plus. And with the current interim dividends, it's a win-win situation in terms of us taking profit as a trader. The people buying are still going to get their interim dividends and final dividends, and the results are okay. So when Zenith started to drop, it affected the banks that all paid interim dividends, going to the UBA, Access Bank. I think the only person that was safe was Stanbic Bank in terms of float. But by the side, there was a report I did write yesterday. Market is playing a script, and the script is, we've seen all these things happen in 2008, from 2008, 2012, 2017. The market is at a cliff now. The highs of 2018 was about 45,000, gone down, we've been trending lower lows till we got to about 20,700 points. Now, that line, it's where the market couldn't break on Monday. So we have a very strong resistance line within this current period. Until market breaks that line, I think the market will just keep floating within these current levels to about 22,000 points. But on the upside, we see an uptrend about 26 to 28,000 points.
All right, Mr. Momo, just before I let you go, now that full deregulation of petroleum has been confirmed, what are your projections for the listed oil and gas companies?
Sorry, I didn't get that.
Now that a full deregulation of petroleum downstream has been confirmed, what are your projections for the listed oil and gas companies?
Well, the only way I'll say that when it comes to market analysis, the most liquid, or let's say the most tradable stock in that sector is actually Wando, and so far there's been no effect yet. We've only traded just 4,000 units so far as at 10:42. So there's really, I think we just have to wait and see what happens. The information has not actually filtered into the market yet.
All right, Mr.
So
Momo, thank you. Mr. Momo, thank you for your input on the program. I guess we'll all have to wait and see. Abdurrashid Momo is a stockbroker at TRW Stockbrokers. Well, we'll leave it there for now. Over to you, Bisi.
Yes, DJ, we'll come back to you shortly, and then we'll cross over to London in just a moment. Please stay with us. Juliana Olayinka is ready for us at our London studio to discuss this morning's headlines. Good morning, Juliana. The number of people going back to work in offices has flatlined in the past 2 months, despite the government's push to get more workers into cities to protect Britain's biggest urban economies from collapse. I guess many are still being very careful, right?
Many people are being very careful, Bissy, and I suppose there are so many contradicting messages coming out of Number 10 at the moment. Of course, yesterday, Prime Minister Boris Johnson announced that from Monday, lockdown measures that had been lifted are going to be restricted again. So for some people, if they can't meet with up to 7 individuals who they know inside their own house, why would they get on a cramped London Underground tube with 50 people? It just doesn't make sense. And then, of course, a couple of weeks ago, we had a senior individual from the Bank of England when he was speaking in front of MPs at the Treasury Select Committee, saying that because of the dense nature of the City of London, it's impossible for workplaces to go back as they were. And I'm not sure Boris Johnson has the complete support from sectors such as banking and insurance and even technology. There are some technology companies that have said they don't expect their staff to be returning to work in the way they did pre-COVID until 2021. So that's the issue that Boris Johnson has been grappling with. But in terms of the actual footfall, there was some data that was published in The Guardian by a think tank that suggested that 63 of the biggest towns and city centres, including London, have seen a flatlining. So since June, they have only seen a 17% of the footfall that we saw pre-COVID. Now, this information does only go up until the end of August. And I've got to tell you, I got into Oxford Circus Station, which is a station in central London, at about 7:30 a.m. And it did appear pretty busy. Of course, we weren't seeing the numbers that we're used to seeing, but there was a little bit of a crowd. It was difficult to socially distance. And I think most of our viewers that live in London would have started to see more people getting out and about. It was in July that Prime Minister Boris Johnson urged people to stop working from home. But many people do actually quite like remote working. So we'll have to wait and see. But of course, Britain is suffering from its deepest recession. And one of the most pivotal, crucial ways that we're going to get ourselves out of that, if we get people back into the offices and they can start spending at the cafes and start buying clothes from the high street.
All right, well, we'll wait to see how all that plays out. Tell us more about the new measures announced by the Treasury, part of which includes that businesses in England that are forced to shut because of the local COVID-19 shutdowns will be able to claim up to £500 a week in government grants.
Well, yeah, this was announced yesterday by the Secretary to the Treasury, Stephen Barclay, in the House of Commons. And this is because a lot of industries are really going through a turmoil at the moment, especially those that are on local lockdowns. So I believe it was on Tuesday evening that the Health Secretary, Matt Hancock, announced that Bolton, a town in the north of England, was the latest to go into a lockdown. So restaurants there were only able to give out takeaway. And this is after being closed for about 4 months. And there are many restaurants that say they just simply cannot survive with this starting and stopping. And so the government have put out this grant. So it's a 3-week grant. So you can claim up to £1,500 because at the moment these local lockdowns are for 3 weeks. And if it increases for another 3 weeks, you can also claim. So it has been welcomed. The Small Business Federation said it was a great thing. Alok Sharma, the business secretary, said no business should be punished for doing the right thing, which is why today's package will offer additional breathing space for businesses that have had to temporarily close to control the virus. So it has been welcome. But of course, for some businesses, this is just not enough. £500 is something they would do in an hour's taking, not least £500 a week. And so unfortunately, again, as we're seeing with the pandemic, there are several businesses that are under this local lockdown that just, quite frankly, won't be opening their doors again.
Very unfortunate, Juliana. Then surveys from mortgage lenders nationwide and Halifax have shown a rise in house prices caused by stamp duty cuts, coupled with increased demand for homes with gardens since the pandemic. Of course, this we see has driven confidence in the housing market to a 4-year high. That's more bad news, isn't it, Juliana?
I'm not sure many would agree that it's bad news. The housing market is a pivotal market to the British economy. And of course, we know with housing, it ebbs and flows. 1 minute, it's good for the buyer. The other minute, it's good for the landlord. And at the moment, it's good for house builders and landlords. That's helping push up the FTSE 250 and the FTSE 100, and it's helping increase the British economy. So I think this is seen as good news, especially even for house buyers and first-time buyers, because there is a stamp duty holiday. So if you're buying a home in England and it's less than £500,000, you don't have to pay stamp duty. And that's what's seeing an increase in property purchases. And also as well, remote working. I know I've done Skypes from home. A lot of people are Zooming, and they quite like the idea of having really nice backgrounds, big gardens, lovely kitchens where they can do their baking. So a lot of people are moving outside of London, looking for large garden space, and also looking for properties that are close to parks. So I think this is being received as some great news, but of course it's not going to last forever. We are expecting a surge of redundancies once the furlough scheme comes to an end in about 6 or 7 weeks' time. And of course, if you don't have a job, you don't have money, and you can't buy a house.
All right, Juliana, thank you. We'll see you again in the afternoon for more updates.
Thank you.
Let's get back to Eddie Young for a review of the debt and currencies market. Over to you, Eddie.
Thank you, BC. The bond market remained bullish yesterday as average yields contracted about 7 basis points. Now, yields contracted on the short and the long end, while the medium end was flat. We had 26 deals worth 8.27 billion naira. So it's a similar picture at the Nigerian Treasury bills market, where yields contracted by about 6 basis points. We had 4 deals worth 620 million naira. The OMO market was also bullish. I'm afraid it was bullish across all markets yesterday. We had 20 deals worth 151.35 billion naira. But Kewe Ewebi, a fixed income dealer at FSDH Merchants Bank, is standing by to tell us more. Good morning, Kewe. Thank you for joining us on the program.
Good morning. Thank you for having me.
So it looks like bullish sentiments were seen across all the markets yesterday. What was responsible for that?
Okay. The market was slightly bullish yesterday owing to the robust liquidity we have in the system. System liquidity yesterday was about 480 billion, and that actually spurred demand for securities in the fixed income market. There was also a PMA auction, primary market auction yesterday, where the DMO issued 128 billion across the 3 standard tenors, the 91 days, 182 days, and 364 days paper. The 91-day paper closed at 1.1%, while the 182 days closed at 1.55%, and then the 364-day paper closed at 3.05%. The stop rate actually printed lower across board, while the auction was highly oversubscribed, also owing to the high level of liquidity in the system. And we expect the bullish trend to actually continue, given the amount of OMO maturities and bond coupon payments coming into the system later this month.
Thank you, Kaya, for those updates. Kaya Ewebi is a fixed income dealer at FSDH Merchants Bank. Well, that is on the market review today. Over to you, Bisi.
Thank you, Eddie. We'll see you again tomorrow for more reviews. And that's our program today. Thank you for watching. I am Bisi Adebayo.